Welcome to Midnight Economist. You're about to hear a story of economics, not the kind you find in textbooks or lectures, but the kind that lives behind headlines. This is the story of the 2008 financial crisis, of a housing boom built on risk and a collapse no one wanted to see coming. So settle in and listen. It began quietly, not with a crash or a panic, but with a sense of calm, of confidence, the kind that comes just before something breaks. In the early 2000s, the US economy was recovering from the dot-com bust. Tech stocks had collapsed, but the broader system had stayed intact. The Federal Reserve cut interest rates to historic lows to keep the economy afloat. And when money got cheap, risk got cheap too. Wall Street began looking for the next big thing. They found it in something safe, familiar, predictable, housing. Everyone needs a place to live. Everyone wants to own a home. And with borrowing costs at record lows, it felt like anyone could. The dream of home ownership became an engine, one that banks, brokers, and investors would soon fuel into overdrive. Traditional lending standards began to soften. No longer did you need pristine credit or solid income to get approved. Subprime loans, once considered too risky, were suddenly in style. If you had a pulse, you had a mortgage, and if you didn't, lenders found creative ways to make it work anyway. Adjustable rate mortgages, zero down loans, interest-only payments. These weren't exceptions anymore. They were the new normal. The logic was simple. If home prices always go up, how could this ever go wrong? And in those years, they did go up, month after month. In cities like Phoenix, Las Vegas, and Miami, houses appreciated faster than people could buy them. Flipping became a business model. Equity was instant. Everyone felt like a genius. TV shows turned house flipping into entertainment. Investment seminars filled hotel ballrooms. Even cab drivers and waiters talked about real estate portfolios. It felt like the whole country was in the game. Banks didn't mind. They weren't holding on to the risk. Mortgages were quickly bundled into financial products and sold to investors. Risk was being sliced, packaged, and passed around like a hot potato. And because those loans were part of the system had to keep growing. Nobody wanted to slow down. Not the lenders, not the home buyers, not the investors. Everyone had a reason to believe it would last forever. But beneath the momentum, something fragile was forming. The market wasn't being built on fundamentals anymore. It was being built on confidence. And confidence, when misplaced, becomes a kind of blindness. Lenders were no longer cautious gatekeepers. They were salespeople, driven by volume. The more loans they issued, the more money they made. And the more exotic the loan, the bigger the profits. On paper, it worked. Because on paper, everything always works. The risks were invisible, hidden beneath spreadsheets, forecasts, and models built on the assumption that home prices never fall. Wall Street loved it. Banks packaged loans into mortgage-backed securities, MBS for short, then into collateralized debt obligations, CDOs, then into even more complex structures that barely resembled the mortgages they came from. Financial alchemy, turning risky loans into golden investments. Investors around the world bought in. Pension funds, insurance companies, foreign banks. They trusted the AAA ratings. They trusted the system. The ratings agencies, paid by the very banks issuing the products, gave their stamp of approval. The risk was spread so thin, it was supposedly gone. But in reality, it was just hidden, layered into complexity few truly understood. And as long as the machine kept running, no one cared. Builders broke ground on new developments faster than ever before. Suburbs expanded outward. Nail guns echoed across empty fields. Supply surged to meet endless demand. Borrowers refinanced their homes to pull out cash. Others bought second or third properties. People with no job or steady income signed for mortgages they couldn't afford. But it didn't matter. Someone else would take the risk. It was a chain. Lenders approved risky loans. Banks packaged them into securities. Agencies rated them as safe. Investors bought them without asking questions. Everyone was making money. And when everyone is making money, no one wants to stop and ask why. The system was built on belief. Belief that growth would continue, that the models were correct, that housing prices were immune to gravity. But belief isn't the same as truth. And trust can only cover so much risk before the cracks begin to show. The truth was simple. This wasn't a housing market. It was a bubble. A slow, swelling illusion of safety, ready to burst. And when it did, the shockwaves would travel far beyond anyone's front door. By 2004, the housing boom had become something else entirely. It was no longer about home ownership. It was about opportunity, about flipping, refinancing, and making money from money. Speculation became normal. Houses weren't homes anymore. They were assets. And in cities across America, people bought properties they never intended to live in. Sometimes 2, 3, even 4 at a time. The logic was simple. Buy now, sell later, profit. Everyone believed the next buyer would pay more. And for a while, they did. Builders couldn't keep up. Construction surged across the country. Entire neighborhoods rose from empty ground, built for buyers who hadn't even moved in yet. Demand kept climbing, but it wasn't driven by population or need. It was driven by credit. Banks had unlocked the floodgates. Subprime mortgages, once a niche market, had gone mainstream. Borrowers with poor credit, low income or no income at all, were approved with little more than a signature. Loan officers stopped asking tough questions. Why would they? They got paid for every mortgage signed, not for its success. Risk was someone else's problem. Adjustable rate mortgages became the norm. 2/28 loans promised 2 years of low payments, followed by sharp increases. But no one planned to keep the loan that long. You'd refinance before that. You'd flip the house. The market would save you. Behind the scenes, these loans were being bundled at lightning speed. Securitization turned 1,000 bad bets into a product that looked safe. Investors didn't see the people behind the loans, just spreadsheets, graphs, and AAA ratings. These products were sold globally. From Tokyo to Frankfurt to London, investors bought slices of the American dream. They trusted the models. They trusted the ratings. They trusted the system. And the system was booming. Home prices soared. Stock markets surged. The financial sector raked in record profits. To most Americans, it looked like a golden age. New homes, rising wealth, easy credit. TV ads promised loans with no income verification. Billboards offered zero-down mortgages with rates too good to be true. Banks competed to offer the most aggressive terms. And people took the bait. No one wanted to miss out. And no one thought it could go wrong. But behind the confidence, the cracks were forming. Slowly, silently. Because underneath every booming market is a risk that no one wants to look at. And the bigger the boom, the deeper the fall. It wasn't just bad loans. It was the speed, the volume, the detachment. Mortgages were no longer about people. They were data points, input for algorithms, fuel for profits. Banks weren't holding loans anymore. They were selling them. They passed the risk to investment firms, who passed it to pension funds, who passed it to synthetic instruments most couldn't even explain. The result was distance. Distance between the person borrowing and the person ultimately holding the risk. And in that space, accountability vanished. Meanwhile, financial engineers created even more complex structures. They sliced mortgage-backed securities into tranches, layers of risk stacked like a Jenga tower. At the top were the safest slices. At the bottom, the riskiest. But those risky slices didn't go away. They were rebundled into new securities, called CDOs, collateralized debt obligations. They promised high returns, and investors couldn't resist. The math said it was safe. The models said risk was diversified, that defaults would be isolated, contained, absorbed. But the models were built on one assumption, that housing prices would keep rising, and that was about to be tested. By late 2006, delinquency rates were rising. Adjustable rate mortgages began to reset. Borrowers faced higher payments they couldn't afford. Refinancing wasn't so easy anymore. Foreclosures increased. Investors noticed, but didn't panic. They trusted the system. Besides, Wall Street had a new trick. Synthetic CDOs. These weren't even based on real mortgages. They were bets on other bets. Financial products layered so deep no one could see the bottom. The profits were enormous, so were the risks. But few wanted to stop the ride. Banks created these instruments, sold them, and often bet against them at the same time. It was the perfect circle, a game where everyone won until they didn't. Inside the industry, some began to worry. There were memos, emails, conversations behind closed doors, but nothing changed. Too much money was being made. Too many reputations were on the line. And outside that world, ordinary people kept signing loans they couldn't afford, believing in the system, trusting the advice, chasing the dream. The boom had reached its peak, and beneath it, the floor was cracking. On Wall Street, the crisis didn't begin with panic. It began with innovation, with cleverness, with alchemy. Mortgages were raw material. They came in, thousands at a time, from across the country, from big homes and tiny ones, from people with jobs and people without. They were bundled, sorted, sliced, and sold. This was securitization. Finance turned into manufacturing. The product was the mortgage-backed security. Investors didn't buy individual loans. They bought slices of a giant pool of them. It spread the risk, or so the theory went. But there was a problem. Some of the loans were toxic, high risk, likely to fail. So banks got creative. They took the riskiest slices and bundled them again into a new product, the collateralized debt obligation, or CDO. A CDO was a security made of other securities, mortgage-backed securities, subprime tranches, other CDOs. It didn't matter. As long as it was rated highly, it could be sold. And they were, over and over again. But where did the ratings come from? They came from agencies, Moody's, S&P, Fitch, trusted names, paid by the banks who needed good ratings. A conflict of interest baked into the system. AAA ratings were handed out like candy, even for securities built from high-risk loans. Investors trusted them. They didn't read the fine print. They didn't understand the complexity. They didn't want to. The demand kept growing, but there were only so many mortgages, so the system invented more. Enter the synthetic CDO. A synthetic CDO didn't require actual mortgages. It was made of credit default swaps, insurance-like bets on whether other CDOs would fail. It was a bet on a bet on a bet, and it was enormously profitable. Banks could create infinite versions of the same risk. and sell them again and again. Each one detached further from the real economy. To outsiders, it looked like magic. Wall Street had turned risk into gold. Complexity became a selling point. Opacity became a feature. Even regulators struggled to follow the web. The financial system had become a hall of mirrors. Reflections of reflections, masking what was real. And deep inside, risk pooled like gas in a closed room, invisible until the spark. While the world watched housing prices rise, a different market was exploding in the background, the derivatives market. Credit default swaps became the silent giants of the system. They worked like insurance, but without regulation. Anyone could buy one. You didn't need to own the bond. You could simply bet it would fail. Hedge funds piled in. Banks sold the swaps. Some firms bought and sold them at the same time, playing both sides of the coin. And since these swaps weren't counted on balance sheets in the traditional way, the risks were buried, invisible to most, but growing fast. Firms like AIG insured billions in toxic securities, confident they'd never have to pay. They didn't set aside enough cash. No one required them to. Everyone was connected. One firm's failure could trigger another's. The financial web was so tightly woven that no one knew where the danger truly was. But they all assumed someone else was watching. In boardrooms, profits justified the risk. In reports, the numbers looked clean. On paper, the system was safe. But paper is patient, and models don't panic. People do. Some inside the system saw the danger. They raised concerns, questioned assumptions, predicted collapse. They were ignored, too pessimistic, too early, too disruptive. As long as the music was playing, everyone kept dancing. The media fed the narrative. Record profits, endless growth, new era of finance. Books were written, awards were given. The smartest guys in the room were on magazine covers. And all the while the foundation weakened. The complexity was a feature, not a flaw. It kept questions away. It kept the money flowing. But every illusion has a limit, and this one was nearing its end. The system was no longer about housing. It was no longer about people. It was about leverage, velocity, extraction, a casino wrapped in spreadsheets, a bonfire built from borrowed money, and somewhere deep inside that blaze, a single match waited to fall. The year was 2006. The energy was still euphoric, but behind the smiles and sales charts, something had changed. Home prices had stopped rising, not everywhere, but enough to raise eyebrows. In Florida, California, Nevada, markets that had grown the fastest, demand was cooling. Properties stayed listed longer. Bidding wars vanished. Builders started offering incentives to sell inventory, and homeowners who had planned to flip their way to wealth, they were stuck. Their adjustable rate mortgages reset. Payments doubled overnight. Many couldn't afford it. They defaulted. Foreclosure signs sprouted like weeds in suburban lawns. It started slowly, a few neighborhoods, then whole zip codes. Lenders, once eager, pulled back. Subprime approvals dropped. Mortgage brokers tightened requirements. Suddenly, easy credit wasn't so easy. The pipeline was clogged, and Wall Street noticed. Banks began to question the assets on their books. How many of these loans would really be repaid? What were these securities actually worth? But the truth wasn't simple, because risk had been chopped up, repackaged, and resold so many times. No one knew who held what. The exposure was everywhere and nowhere. Investors grew nervous. Funds began to wobble. Some froze redemptions. Others quietly sold off risky assets. In early 2007, cracks became fractures. New Century Financial, one of the largest subprime lenders, collapsed. Bear Stearns bailed out 2 of its mortgage hedge funds, and suddenly the headlines changed. This wasn't a housing correction, it was a crisis, a chain reaction triggered by defaults that had once been brushed aside. The public barely noticed at first. Stocks were still high, jobs were stable. But beneath the surface, the gears had jammed. Confidence began to slip, and in finance, confidence is everything. The bond market trembled. Investors couldn't price the securities they owned because no one was buying. And without a buyer, value was just a guess. Ratings agencies scrambled. They downgraded hundreds of mortgage-backed securities in a single month. The same assets they'd once stamped as AAA, now suddenly labeled junk. Banks braced for losses. Some admitted exposure. Others denied it. Most weren't sure how deep the problem ran. But the math was relentless. Millions of borrowers were behind on payments. Thousands of homes were in foreclosure. And the securities built on them were unraveling. Liquidity dried up. Trust evaporated. Lenders stopped lending to each other, to businesses, to the world. In August 2007, BNP Paribas froze withdrawals from 3 investment funds. They couldn't calculate what the assets were worth. The news sent shockwaves through global markets. It was no longer contained. The cracks were everywhere now, and they were widening. The Federal Reserve took notice. So did central banks in Europe and Asia. They pumped money into the system, trying to calm the panic. But it wasn't a problem of money. It was a problem of trust. And trust, once broken, is hard to restore. Behind closed doors, executives met. Strategies were rewritten. Balance sheets re-examined. Still, many believed the worst had passed. That the market had overreacted. That confidence would return. But confidence isn't just belief. It's belief backed by clarity. And in 2007, clarity was in short supply. The fuse had been lit, the fire was spreading. And 2008 was just around the corner. 2008 didn't begin with fire. It began with silence. Deals slowed. Confidence wavered. But the world kept moving, just slightly more cautiously. Then came March. Bear Stearns, a titan of Wall Street, was on the brink. Rumors of insolvency spread. Clients pulled their funds. Counterparties refused to trade. In a matter of days, the firm collapsed. The Federal Reserve stepped in, engineering a rescue. JP Morgan Chase acquired Bear for just $2 a share, a fraction of its former value. Markets shuddered, but didn't break. Investors hoped this was the bottom, a necessary correction, a warning. But it wasn't the end. It was the opening act. Summer brought more signs of decay. IndyMac Bank failed in July, one of the largest bank failures in US history. Fannie Mae and Freddie Mac, the massive government-sponsored mortgage lenders, were bleeding losses. By September, both were placed under federal conservatorship. Then came Lehman Brothers. The firm had survived the Civil War, the Great Depression, and 2 world wars. But it would not survive the crisis it helped create. On September 15th, 2008, Lehman filed for bankruptcy. No bailout, no buyer, just collapse. The shock was immediate. Global markets plunged, credit froze, trust vanished overnight. It was the largest bankruptcy in US history, and it changed everything. Lehman's fall sent a signal. If they could fail, anyone could. No firm was too big, no balance sheet too solid, no reputation untouchable. The contagion spread. AIG was next. The insurance giant had written hundreds of billions in credit default swaps. And now it owed more than it could pay. Without intervention, AIG would collapse, taking countless institutions with it. The government stepped in, an $85 billion bailout, not to save AIG, but to stop the chain reaction. And still, the damage grew. Money market funds broke the buck. Stocks plummeted. Unemployment rose. Companies cut spending. Consumers froze. The economy wasn't just slowing, it was unraveling. In October, Congress passed TARP, the Troubled Asset Relief Program, $700 billion in emergency funds for the banking system, a desperate attempt to restore confidence. But confidence doesn't come back with a signature. It takes time and pain. Throughout the fall of 2008, headlines blurred into chaos. Banks merged, others failed, markets swung wildly. Ordinary people watched their savings vanish, their home values crater, their jobs disappear. Lines formed outside failing banks, families lost homes, pensioners lost retirement funds. The illusion of stability was gone. This wasn't just a financial crisis, it was a crisis of belief, in markets, in institutions, in the system itself. And the worst was still to come. The dust didn't settle. It just hung in the air, thick, heavy, and uncertain. By early 2009, the crisis had infected everything. Global trade slowed, jobs vanished, entire industries reeled. In the US alone, more than 8 million people would lose their jobs. Home foreclosures surged past 3 million. Stock markets had lost half their value. What began as a housing issue had become a global recession, the worst since the Great Depression. Governments rushed to respond. Central banks slashed interest rates to near zero. Emergency stimulus packages were launched. Trillions were spent to keep economies from collapsing. But trust was slow to rebuild. People held onto their money. Businesses held off on hiring. Lending remained tight. The scars ran deep. Savings were gone. Retirements delayed. Dreams postponed. Meanwhile, politicians promised reform, new laws, stricter regulations, better oversight. The Dodd-Frank Act would follow. Thousands of pages aimed at preventing the next collapse. Banks were forced to raise capital. Risky trading was curbed. Transparency improved, at least on paper. But many questioned if it was enough, if anything had truly changed. The financial system was more concentrated than before. The biggest banks had grown even bigger. And the people who caused the crash, most kept their jobs, their bonuses, their power. For many, it felt like justice had been evicted, just like their homes. The public grew angry. Protests erupted. Movements were born. The words "too big to fail" became a warning, a symbol of a system that served the few at the cost of the many. In cities across America, tent communities sprang up, makeshift shelters for those without homes. In living rooms, families whispered about whether they could hold on, about how long the unemployment checks would last, about whether their children would be better off. In Europe, the crisis triggered its own wave of devastation. Banks in the UK, Ireland, and Germany revealed their exposure. Greece collapsed under debt. A sovereign crisis ignited. Entire nations were forced into austerity. Public services cut, pensions reduced. Protests filled the streets of Athens, Madrid, and Rome. The ripple effects of Wall Street's collapse were now planetary. And still, people asked, how did this happen? How could the smartest people in finance, the rating agencies, the regulators, miss it? The answers were both complex and simple. Greed played a role. So did denial. so did a blind belief in markets, in models, in credit scores, in trends. Warnings had been ignored. Oversight had been gutted. The culture rewarded short-term profits over long-term caution. Finance had become too fast, too complex, and too disconnected from reality. By 2010, recovery began. On paper, markets rebounded, profits returned. But for many, the recovery was a mirage. Wages stagnated, inequality widened. The top 1% recovered quickly. The rest of the world didn't. It wasn't just money that was lost. It was faith in institutions, in fairness, in the idea that hard work guaranteed stability. The crisis redrew the social contract. Young people entered adulthood with fewer opportunities. Home ownership became a distant dream. Debt became a permanent companion. And through it all, the question lingered: could it happen again? New laws promised protection. New watchdogs were created. But memories fade, and profits are persuasive. The system didn't collapse entirely, but it didn't emerge unscathed. It survived, leaner, warier, more fragile. The illusion of invincibility was gone, and in its place, a quiet anxiety remained. The world had learned a lesson. Whether it would remember was another story. You've listened to a story by Midnight Economist, a story about the 2008 financial crisis, how unchecked risk, blind optimism, and a fragile housing bubble brought the global economy to its knees. Thank you for listening. Until next time, rest easy and stay curious.